Hello, everyone. Thank you for joining with us today. My name is Jeremy. I'm with the Life Wealth Group. Let me blow myself up here 1 second so you can see my face. All right. Thank you for joining with us today. Today we'll be talking about a topic. Thank you for joining with us today. My name is Jeremy. A topic everyone seems to be interested in. The topic is how to help protect yourself from a potential tax storm. Before we get started, I wanted to give you the chance to get settled in, and if you're at home, you can grab a glass of wine. I know that I'll be grabbing my glass of wine here, so just want to get you settled in so you can relax and enjoy the presentation. In the meantime, I'm going to take a poll to get your thoughts on your opinion as to what the future outlook of taxes looks like. So I'll put that up now, and then we'll wait for your answer, and then we'll get started. So do you think the forecast is sunny or cloudy? All right, looks like 77% say that it's cloudy. So I think I'll just change up the mood here just because I want to reflect how people are feeling these days. So we'll get started with the presentation here. This is how to help protect yourself from a potential future tax storm. This is a topic that a lot of our clients are interested in, and what we want to do is just take some time to give some content to people so that they can kind of get a context of what's expected in the future. So I'm going to get this presentation started. There we go. All right. So just a word for our compliance team. This is what they want us to show. So, anything that we say today should not be construed as a recommendation. All right, so we'll get started here. Today's agenda, we'll be talking about where are we right now and how did we get here. We want to see where we're at as a nation and how we got here to this point. We want to talk about where could we go. Is there a potential future tax storm in the horizon? Could your taxes be on the way up? When we're looking at our income taxes going forward, what should we expect? And how should we look at income taxes for individuals like you, as well as for businesses? And finally, what can you do right now to help protect yourself no matter what the future holds? We'll also talk about 3 action steps that you can take starting today to help ensure that more of your hard-earned money stays with you and your family versus going to the government. So, a common myth that people believe is that they believe that their taxes will be lower in retirement. So, we have to explore whether this is true or false over the last couple of years. The answer is it depends, but it's likely false. Myself, many of us have been operating under the presumption that our taxes in retirement will be lower in the future. And particularly in retirement. And therefore, we choose to use savings vehicles like IRA accounts and 401ks, for example. Now, when we think about our grandparents, they probably did fall into a lower tax bracket in retirement. They stopped taking vacations. They spent less than what they were when they were working. They tightened their belts. And so they didn't really have a lavish lifestyle in retirement. And so in that, they paid less in income taxes because they have to pull less out of their retirement assets. But for some of our parents, it's been a different story. They've been going out to every new restaurant. They've been traveling, going on big family vacations. Their retirement spending may actually outpace that of their working years, which requires more spending out of their retirement accounts. For baby boomers, this often holds true as well. Retirement is seen as a reward for years of hard work and savings, and they want to look to maintain their income in retirement to meet their goals and their dreams. So some of the reasons they don't fall into a lower tax bracket are that they have fewer tax deductions. Perhaps their home is paid off and their children are out of the house. They want to travel and enjoy hobbies they didn't have time for while they were working, and that means more spending. And future tax rates are finicky and are likely to be higher than during their working years. Historically speaking, we're currently at some of the lowest tax rates we've seen in our nation's history. A visual example of that is if we look at So this is an illustration of tax thresholds in the past. So we can see back in 1913, we have different tax thresholds for the top tax rate. So we see here that the top tax rate in 1913 was 7%. And the threshold for the highest tax bracket was $500,000. So if you made over $500,000, then your tax rate for every dollar above that was 7%. And then taxes were meant to be temporary, provision for the government at that time, and then it quickly became an ongoing need to be able to produce revenue. So in 1916. If you made $2 million or more, it was taxed at a 15% tax rate, which was the highest tax rate at that time. If we fast forward a couple years to 1941, then we could see in this year we had a top marginal tax rate of 81%. And if you made over $5 million, then you were taxed at the 81% rate. Now look what happens in 1942. Congress changes the rules, so you're taxed at an 88% top marginal tax rate, but the threshold for the highest bracket changed from $5 million to $2 million in 1 year. So all of a sudden, 1 year later, if you make over $200,000, you're paying 88% tax rate on your income. So you can see how things can change quickly based on the tax rate as well as the tax bracket. So with our retirement accounts, one of the things that we want to be cognizant of is that we have a silent partner, which is the IRS. So as our 401k accounts grow, we have a share of that account, but so does the IRS. If you have $1 million in your 401k, it might feel like $1 million, but when you go to distribute that money, the IRS takes a certain percentage based on your income tax rate. So some of our favorite retirement savings vehicles like IRAs and 401ks allow us to defer paying taxes on the contributions into those accounts. However, when we go to take it out, we have to pay taxes back to the IRS on the amount that we contributed as well as the growth. So in effect, the government is our silent partner and kind of like a joint account holder, and they want their taxes paid in the future. But the thing here is that there's no guarantee what those tax rates will be when the government is ready to collect. So whenever you're distributing from your accounts, they determine what is the tax rate as well as what is the tax bracket or the threshold for income for those tax brackets. So it doesn't seem like a very fair partnership, does it? So where are we right now and how did we get here? Okay, so all right, so this is going to be an illustration of the nation's tax history. So this is the same graph that we looked at in the number format, but this is a graphic format. So not a lot of people have seen tax rates this way. So in the beginning, it was, kind of a nominal, 7%, which was supposed to be temporary. But then these events in our nation's history happened, like World War I. So our tax rates increased significantly. The stock market crash in the 1930s, the Great Depression. And then right here is that year where in 1 year, people making $5 million or more were considered rich, and so they were taxed at 81%. The next year, the Congress decided that anyone making over $200,000 a year was rich, and so they were taxed at 88%. So if we look in comparison of today, our tax rates are significantly lower, or at least they're low in comparison to the nation's history of taxes. If we look at what the average tax rate over that time period was, it was around 57%. Let me get there. Okay. So ever since the shutdowns grounded the economy last year, Congress and the Federal Reserve have pumped trillions of dollars into programs that are aimed at fighting the coronavirus and bailing out industry and small business, in essence, to save the economy. Congress has green-lighted stimulus spending in the amount of trillions of dollars with 4 relief bills, all of which must be repaid at some point in time, which is virtually assuring that there will be higher taxes in the future. There's even talk about additional stimulus to come as long as Congress can agree. And the Federal Reserve is committed to potentially up to $4 trillion in relief efforts on its balance sheet. This is a picture of a website called usdebtclock.org, which helps measure what the federal national debt is, as well as federal budget deficits each year. We can see that so far we've collectively accumulated a massive debt to the tune of $28 trillion, and federal budget deficit spending of $3 to $4 trillion per year. So what that means is that we're borrowing money and going into further and further debt, which at some point needs to be repaid, and which gives us the idea that that's going to be repaid through taxes over time. You can see that the debt per citizen is about $84,000, which is distinguished from the debt per taxpayer of over $200,000. So where could we go from here? Could your taxes be on the way up? There's a good chance we'll see higher taxes in the future compared to today's tax rates. As we saw, we have historically lower tax rates, and the need for government spending and revenue leads us to believe that they'll have to use their taxing authority to be able to repay the debt and even service the current debt. So there's a very high likelihood that that could happen. Another way to illustrate that is to look at our debt to GDP ratio. So at the end of the first quarter in 2020, the debt to GDP ratio was nearly 108%. By the end of the second quarter, it had grown to about 136%. And why is debt to GDP important? It's a measure of the country's capability to pay off its debt. A higher ratio means that a country isn't producing enough in GDP to be able to pay off its debt in any given year. So during this time of extreme spending, it was a concern to hear the former U.S. Treasury Secretary, Steve Mnuchin, basically setting aside concerns about the deficit. He says, in different times, we'll fix the deficit. This is not the time to worry about it. But notice he doesn't say that we won't fix the deficit. He just says now is not the time. If now isn't the time to worry about it, we should be concerned when the government does start to worry about it and what the outcome will be for the U.S. taxpayers. Another reason we can anticipate higher taxes in the future is that the Tax Cuts and Jobs Act that was passed in 2017 made substantial changes for tax rates for individuals, reducing tax rates at almost all levels and shifting the thresholds for several income tax brackets. But those tax cuts are scheduled to expire December 31st, 2025, unless the cuts are extended by Congress. And we've seen how well Congress is able to agree on anything these days. So when they do expire, our 2026 tax rates would revert to the pre-Tax Cuts and Jobs Act level, those higher tax levels virtually guaranteeing a tax hike for many of us. Let's see. You may have heard people say before our tax code for retirement is essentially written in pencil. Considered how it's been revised and things have changed at any time, depending on what political parties in power and what challenges we face. It would be absurd to think that our tax rates would be the same for the next 30 years. In fact, there's a few ways we can end up paying more taxes, sometimes without even realizing what's happening. For example, tax bracket changes. The IRS can change the tax brackets and they can reflect inflation in changes in cost of living. So you can find yourself in different tax bracket based on those adjustments alone. We also mentioned that the Tax Cuts and Jobs Act expires in 2025. And we know that we could end up being in a new tax bracket due to that reversion back to the old rates. We also can see changes to deductions. It's not particularly popular to vote for a tax increase, but changes in deductions and exemptions and tax credits can have just as large of an impact potentially on one's tax bill, and such changes could be easier for Congress to pass. For example, with the Tax Cuts and Jobs Act, while the standard deduction was increased, personal and dependent exemptions were eliminated, and we're moving expenses and alimony deductions. Other taxes can affect your bottom line depending on your income. You may have to pay taxes on up to 85% of your Social Security benefits. And note that Congress and Social Security Administration could change that at any point. And while not officially a tax, higher Medicare premiums, Part B, and prescription drug coverage await those whose gross income exceeds certain levels. So if your income exceeds certain levels, there's certain surcharge taxes that they'll assess. So what can you do to help protect yourself? One of the things that you can do is determine, what is your current circumstance to help protect yourself and your financial future, regardless of where tax rates land in the future, regardless of what party controls the White House or Congress. You can take steps now to help get into control of your finances. A lot feels outside of your control, but the reality is that you've spent a lifetime preparing for retirement, and let's see, in the time feels, the reality is that your finances and your retirement you've spent a lifetime preparing for don't have to. So you can get back into control of your own retirement and finances when things feel out of control. Those things actually can be in your control. And if you think over what your tax picture looks like in retirement, protecting yourself starts with understanding the difference between micro and macro view of taxation. A micro view focuses on your current year's taxes. Using a CPA will normally look at what your taxes are in this year. And they do have a longer approach, but typically the financial planner is the one who takes out the telescope and looks at your retirement as a holistic picture over 30, 40 years. The CPA is more so bringing out the microscope and looking at 1, 2 years and trying to help you there on your tax bill. But together, they can have a very potent effect on being able to change your projection of your taxation in retirement. So one of the things that you can consider is implementing tax strategies. Today, we'll talk about several big picture tax strategies that can help you take control and protect yourself no matter what the future tax rates look like. We'll talk about 3 actions you can take to make those strategies part of your comprehensive financial planning and take you through retirement. So one of the things that we do here at the Life Wealth Group is we will do a tax diversification review. And we'll take 15, 20 minutes of your time to look at where your assets lie in terms of if they have, or if they're postured in a balanced way so that you can be able to pull from your different accounts and lower your tax rate in retirement. So if you'd like to schedule time to go over a conversation with Hilgart, then you can contact Susan at susan@lifewealthgroup.com, or you can contact us at 407-299-4129. We'll set up a 15-minute conversation, and then we'll have a brief overview of where we can see where your assets lie in terms of the tax diversification. So normally we categorize assets into 3 different buckets. So we have the taxable bucket, the tax deferred bucket, and then the tax-free bucket. When we look at these 3 different buckets, our goal is to move more money out of the income taxable, the tax deferred, and into the tax-free bucket. But doing so requires planning, and it requires looking at your particular situation. The income taxable bucket could be your pension, it could be short-term capital gains, stock dividends, interest on CDs, taxable distributions from your non-qualified accounts. And those are the accounts that produce a 1099 each year, regardless of if you make a withdrawal. Tax deferred buckets might include your IRA, your 401k. You could have an annuity or savings bond. Then the income tax-free buckets include your Roth IRAs, your municipal bonds, and life insurance if properly structured. So the first step to knowing where among these 3 buckets your assets are located, and that's setting a time with Hilgart. And the next step is considering whether moving some of that money from the taxable to the tax-free bucket is an option for you, and if that fits your situation. So what we'll also do is we'll have a tax diversification review, which is completely free. We'll talk about how your assets are diversified across the buckets, and we want to provide some clarity around how to position those assets in a way that can reduce your taxable income in retirement. So the way to be able to take advantage of lower tax brackets today is to look at Roth conversion strategies as a potential option while our tax rates are in the lowest or close to the lowest in history. So currently we're in a window of time where taxes are on sale, and such conversations can essentially be made at a discount. When we talked about the Tax Cuts and Jobs Act of 2017, that reduced many taxes for a lot of us. And we talked about how those cuts are set to expire. And if those do expire, we're looking at higher tax rates for many of us. And that gives us a 5-year window of opportunity. You can see that many of those who are in the 22-24% tax bracket for couples who are married filing jointly could find themselves bumped back into the 28-33% tax bracket. And those are fairly significant increases. We're also enjoying pretty generous standard deductions of $24,000 for married filing jointly. Those will also revert back to the pre-Tax Cuts and Jobs Act level of half of that amount, or $12,000. So, for example, Dave and Sarah have $170,000 of income. In 2017, they were in the 28% tax bracket. As a result of the Tax Cuts and Jobs Act in 2020, they were moved into the 22% tax bracket. And in 2026, assuming that the Tax Cuts and Jobs Act expires, they'll be moved back into the 28% tax bracket. So we have a pretty defined window of time that we can make decisions on conversion strategies. So, for example, let's say they're considering converting $100,000 from an IRA to a Roth and paying the taxes now. If they made the conversion in 2017, the cost would be approximately $33,000 or 33%. If they made the conversion in 2020, the cost would be approximately 24% or $24,000. That's more than a 25% tax savings, or about 27% to be exact. So if you're curious as to whether you are paying too much in taxes, I have a brochure that you can download, and I'll put that, make that available for you right now. So, looks like I may have deleted that. 1 second. There it is. Okay. Okay, making that available right now, so you should be able to download that white paper. Susan will also make that available to you after our presentation. All right, so so if Dave and Sarah choose to reduce their future tax liability by paying some of the taxes today and shifting money into a tax-free account, like a Roth IRA, they can enjoy some benefits, which include tax-free distributions in retirement, which is a big plus. It helps balance out your taxable income sources. If you're over 59 and a half, you'll have immediate access to the funds tax-free with no penalties. However, with Roth IRAs, you will have to wait 5 years to tap into investment earnings without penalty. Roth accounts won't have any required minimum distributions, so you have the freedom to choose when to take money out from the account. It will also be a potential tax-free inheritance to beneficiaries, and it's immunized against future tax laws, which is important. So one of the things that we can look at together is if converting assets to Roth makes sense. If you're wondering if you have any assets that would qualify for a conversion that would potentially save you on future tax bills, then we can look at your full financial picture and identify opportunities. One of your, let's see, so what we'll also make available right now is we have option to contact Susan at the Life Wealth Group to schedule a time so that we can look at this Roth conversion analysis and see if it makes sense for your circumstances. So one of the things that we do for all of our clients is we develop a income plan, which helps us determine which accounts to pull money from at what times, and so that we know how much to distribute from you and to you each year to fund your lifestyle expenses and your future dreams. And the way we do that is we do it so that we minimize the income taxes as much as possible to keep you within the tax brackets to reduce your overall tax rate. And by coming in and reviewing your assets to see if a conversion makes sense can help protect you from future tax increases, which is the ultimate goal, which is to help you increase your wealth so that you can increase your lifestyle and enjoy life and enjoy your wealth while you're living. We want you to enjoy your retirement that you've always dreamed about and be confident that you can live independently without worry of running out of money. Whether that's spending days on the beach or traveling, or simply spending time with your family, your kids, and your grandkids. And so that's one of the benefits of developing a tax strategy. So what we do here at the Life Wealth Group is we look at comprehensive planning. We don't just look at taxes, but also we do an income plan. We develop investment recommendations and measure your risk tolerance. We look at healthcare plans and your estate planning. So we tie all of that in together because they're all interrelated, and so tax planning is just one of those topics. Just like we want a vehicle for your loved ones that's been crash tested and shown to be safe, every person needs to crash test their portfolio to ensure it meets the amount of risk that they're willing to take, whether that's risk in the market or risk of future taxes. Crash testing is all about a comprehensive review process. So one of the important things is understanding or having a written retirement income plan. That way we know when our paychecks in retirement will start, when our distributions from our account starts, where they will come from and how long they'll last, and how they will continue to grow over time. So that's one of the things we want to illustrate in our conversations. So the third action is getting a written retirement plan, which is what we specialize in. So if there's a time that you want to set with Hilgart, we can get the process started so that we can get a picture of your retirement. So the difference between death and taxes is death doesn't get worse every time Congress meets. So every time Congress meets or every time a new administration is ushered in, it seems like there's a new tax laws that are implemented. And so what we want to do is just keep up to date on the different changes of the tax laws. A couple of those changes just quickly that are being proposed with Joe Biden's tax plans. A summary includes, talking about repealing some of the Tax Cuts and Jobs Act components for high income filers. He's talking about creating a payroll tax for those earning over $400,000 per year. which is a Social Security tax of 12.4% that's shared between employer and employee. He's planning on increasing the corporate income tax rate to 28%. It was previously at 37, I'm sorry, it was 21% previously. And he was wanting to establish a corporate minimum tax, which is basically an alternative minimum tax on businesses so that they will have to pay a minimum tax no matter what deductions that they're taking. He's also proposing a tax rate on international income for U.S. corporations. And it's called the GILTI tax. And he's basically taking what the Tax Cuts and Jobs Act did and then doubling the income tax on that income. He's also imposing it country by country. And then also talking about increasing the child tax credit. So there's a lot of different things that Biden's proposing, but the ultimate theme is that it's the government is needing the tax revenue to be able to pay and service the debt that we're currently in. So we do, although in these proposals, it's targeted toward the more higher income earning individuals over 400,000 and businesses, we still expect that there's going to be a need to be able to levy the power of taxing on individuals as well in the future. So we would like to have you come in if you're a client or if you're a prospective person who would want to meet with us. We'll be glad to have you and answer any questions that you have and look at your particular situation. That concludes my presentation. I'll just double check to see if there's any questions in the chat room. Looks like. So Tom Potthast, he says, do you think these changes will occur for 2021 year or wait until 2022? The truth is that after the coronavirus vaccination implementation in the country is fully implemented and we're able to open the country back up, I believe that it'll be by the end of 2021, beginning of 2022. So to answer your question, it could be within the next year. I don't know if it's going to be this year or early next year, but I believe that they'll be looking at proposing tax changes within the next year as a priority for what they're wanting to implement. All right, I don't see that anybody has any other questions at this time. Thank you for your time. We'll have a recording that will go out and so that you can access it, but we'll have Susan make that available to you. I appreciate your time and hope you have a great night, and we'll see you soon.